Welcome to our deep dive on navigating a $200,000 debt crisis in a small business serving critical infrastructure. We will move quickly but methodically through the steps that protect cash, restructure debt, stabilize operations, and protect your well-being. First, we will clarify the stakes and set expectations for what survival looks like. In this video, we will cover a crisis snapshot, a 48-hour triage plan, financial survival strategies, price strategy and cash flow, legal recourse, how to avoid burnout, how to protect yourself from unaligned partnerships, a 90-day stabilization plan, mentorship resources, key takeaways, and short quizzes to reinforce learning. Next, let us ground ourselves with a brief but critical disclaimer. This video provides general education and is not legal, financial, or mental health advice. Regulations, lender policies, and liability rules vary by jurisdiction and situation. You must consult qualified professionals, such as a business attorney, CPA, SBA lender, or licensed therapist before taking action. If you are in crisis or at risk of harm, immediately contact local emergency or crisis resources. With that established, let us examine the stakes of this scenario. Critical infrastructure depends on specialized small businesses to maintain safe water, reliable power, and essential systems. When internal failures or frauds strike, the resulting financial devastation can threaten both livelihoods and community services. That is why decisive action is essential. Now, let us move into precise, high-impact steps you can implement immediately. Start by cataloging every business obligation with balance, APR, and payment. Compute your blended interest rate across all debts. If the blended APR exceeds 8%, explore rolling high-interest debt into an SBA 7A working capital facility with a term up to 10 years, which can materially reduce monthly payments and extend runway. Simultaneously, raise prices modestly, generally between 1 to 5%, to reclaim margin and offset interest costs. Rebuild cash discipline by front-loading milestone invoices and tightening collections. If any portion of the collapse involved employee theft or fraud, report the crime immediately and consider pursuing a civil judgment to recover losses. Now that you have the triage map, let us compress the first 48 hours into a clear sequence. First, secure your cash by locking down bank access and stopping all non-essential expenditures. Next, catalog each debt and compute the blended APR so that you can decide on refinancing paths. Then, pause any draws on new credit lines until a formal plan is set. After that, draft a modest price increase and prepare clear client communications. In the next step, contact SBA lenders and schedule meetings with an attorney and your CPA. Implement a weekly cash runway tracker so you can see exactly how many weeks of operations you can fund. With immediate actions underway, let us quantify how price changes counter rising interest costs. Consider this example. If monthly revenue is $200,000 and your net margin is 8%, your net profit is $16,000. A 1% price increase adds roughly $2,000 per month, which can partially or fully offset rising interest costs. Because fixed costs dominate in many specialized services, much of the incremental price flows to profit. Additionally, front-load milestone billing by requesting 40 to 50% at project kickoff to pull cash forward. Finally, analyze profitability by service line and discontinue or reprice low-margin work. With pricing levers clarified, let us solidify understanding with a quick quiz. Quiz time. The question is, at what blended interest rate should you seriously explore rolling high-interest debt into an SBA 7, a working capital loan? Your options are below 5%, 5 to 8%, above 8%, or interest rate does not matter. You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is above 8%. When the blended APR exceeds roughly 8%, a 10-year SBA 7, a working capital facility, can significantly reduce monthly payments and extend runway. Now let us address legal recourse in cases involving theft or fraud. If employee theft or fraud is suspected, report it to law enforcement immediately and preserve all relevant evidence such as emails, logs, invoices, and access records. Work with legal counsel to pursue a civil judgment that may assist recovery. Contact your insurer if you carry fidelity or crime coverage. Strengthen internal controls by adding dual approvals and segregation of duties to prevent recurrence. Next, we will confront the human factor and the danger of trying to wear all hats during recovery. Founder overload is a leading cause of secondary mistakes. Offload specialized work such as initial design pre-work to manufacturers, and engage a fractional chief financial officer or bookkeeper for weekly cash control. Consider a freelance project manager or operations specialist to stabilize delivery. Establish personal boundaries that define work hours, decision rights, and escalation paths. Objectively assess whether a 2 to 4 year turnaround is feasible without sacrificing your salary and health. With the team structure in place, we must also protect ourselves from unaligned partnerships and shared liabilities. Understand how your state handles spousal and partner liabilities, including community property, or similar rules that may create shared responsibility for business debt. Define clear legal boundaries through appropriate agreements or separations, as advised by counsel. If a partner or spouse refuses to acknowledge the crisis or share the operational burden, consider counseling or legal guidance to protect your finances and independence. Prioritize your personal stability and be willing to discontinue unprofitable projects or unsupportive relationships. Now, let us turn this into a structured 90-day stabilization plan. During weeks 1 and 2, implement price changes, advance invoices, and hold daily cash huddles. During weeks 2 through 4, submit SBA 7A or other refinancing applications, begin legal recovery actions, and tighten internal controls. During weeks 5 through 8, collect receivables aggressively, renegotiate vendor terms, and eliminate low-margin offerings. During weeks 9 through 12, finalize restructuring, expand support roles, and document standard operating procedures. Update the cash runway weekly, and run downside and upside scenarios. Before we wrap this plan, let us reinforce with a quick knowledge check. Second quiz. Which action is most likely to reduce monthly payments quickly while extending runway in a high-rate environment? Options: taking a short-term payday-style loan, cutting staff immediately without a plan, rolling high-interest debt into a 10-year SBA 7A, or waiting 6 months to see if revenue improves. You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is rolling high-interest debt into a 10-year SBA 7 loan. Extending the term on cheaper capital lowers monthly payments and buys time to execute your turnaround. Next, let us anchor external lifelines you can tap immediately. Seek support immediately. Escori offers free, expert mentorship, and targeted consultations with industry veterans can accelerate decision-making. Peer groups and founder forums add accountability and perspective. Consider therapy or coaching to manage stress and maintain clarity. Above all, remember that your identity and value are not defined by your company's balance sheet. Now, let us crystallize the most important points. Pivoting involves repricing, focusing on profitable niches, and restructuring debt, which can preserve the brand and team while building long-term value. But it usually entails a 2 to 4 year grind and requires strong discipline and support. Selling or exiting through an asset sale or orderly wind down can stop the bleeding, reduce personal risk, and provide a reset. But it may require accepting reduced recovery and doing reputational repair work. Choosing between these paths depends on your runway, market position, and personal constraints. With that comparison in mind, let us summarize the key points. The core actions are to restructure debt with attention to the blended APR, raise prices 1 to 5% and front-load milestone billing, report fraud quickly and pursue civil recovery, stop wearing all hats by building a support stack, protect personal finances with clear legal boundaries, and execute a 90-day plan guided by a weekly runway tracker. As we close, here is a brief summary. Your path forward is to triage immediately, act decisively, and measure weekly. Use SBA 7A or similar refinancing to lower payments if your blended APR exceeds 8%. Price increases and stronger collections are your fastest cash levers. Take appropriate legal action and reinforce internal controls to prevent recurrence. Finally, build support systems that protect both the business and your health. Before you go, we have one final ask. Thank you for watching. If this video helped, please like, share it with another founder who needs it, and subscribe for more turnaround playbooks. We would love to learn from your experience as well, so share your tactics and questions in the comments.